Yes, we can.
Okay, thank you. Because we changed the room, and so everything is new here. Okay. Okay, so let's start. Any questions? Okay, so let me just okay. Oh, okay, so if there are no questions, let me just briefly tell you what we're going to do the next lectures, because we have 3 lectures left, right? And but most likely I won't use all the time we have available. Okay, so because I don't want to go over, I don't want to do more than planned initially. So I would like to, therefore, do the following. So I would like today finish what we started yesterday, the last lecture, and that is I would like to here finish the results of the general model. Okay, in particular, now I'm going to talk about the Euler equation. That's something that is used also in empirical studies, in particular to estimate the discount factors, elasticity of substitution, and therefore is a way to estimate the social discount factor, if you want. Okay, that's then used in many empirical studies. In particular, it's relevant for climate change economics. And then once I've mentioned the Euler equation, or once I've discussed the Euler equation, I'm going to talk about sustainability, and going therefore back to what I've mentioned yesterday and lectures before, to give you some insight about sustainability and substitutability. But now we have some formal results we can play with, and therefore you get more insights compared to what we have seen in the past lectures, where we just had intuition, okay, rather than some formal results. Here you see why substitutability is important for sustainability. Okay, I'm going to give you just a brief insight, and then what I'm going to do today is talk about some empirical results and some extensions. In particular, I'll briefly talk about renewable same time, the use of these non-renewable resources also leads to pollution, and therefore how to deal with pollution, okay, from a policy point of view. Okay, this is a very simple model of economic, going to be a very simple model of climate change. Okay, just to give you some insights of what should be done. Is this fine? So I guess I won't use all the time available. Okay, if it's okay for you. Okay. Otherwise, I would need to talk about renewable resources, okay, and there would be additional stuff, and then I think it's going to be too many topics, okay, and that would be kind of, even though it would be perhaps interesting, but it would be perhaps more difficult, okay, for, and that's and that's something to the lectures. Okay, well, let's see how it goes. Okay, is it okay? Okay, I think we changed because here the air conditioning is working. I don't know if you. So there is strong air conditioning. I feel it at least. You don't feel it? Okay, you feel it. Air conditioning is working. Yeah, that's why they're not really happy about opening the doors and.
Should we close it?
I don't know about you. I don't care.
It's not so efficient.
It's up to you. Okay, I don't care. Okay. No, I just noticed now because it's quite. I feel it quite strongly. So I don't know about you. So if you want, I mean, if you're worried about the pandemic, COVID, so on and so forth, you cannot let it open, okay? Because
I don't think anyone's concerning about. I mean, maybe anyone.
I'm asking you, okay? That's why.
Ragazzi, dobbiamo fare.
It's up to you, okay? If you wanna.
Chiudo.
Okay. Okay, so let's start. Okay, so yesterday we've seen efficient condition for social optimality, so the optimal and efficient use of non-renewable resources. So we have seen, if you remember, static and dynamic efficiency conditions. So the static efficiency condition, remember, they are just standard economic reasoning where you compare what the marginal benefit and the marginal cost is of doing something, and what you do is you equalize the marginal benefit across different uses, or you equalize marginal benefit, marginal cost. So quite standard reasoning. So what is new here is the intertemporal trade-offs, which are the dynamic efficiency conditions, and here this is related to the rate of return to the assets. Here we have two assets, the capital stock and the non-renewable resource. And therefore, what the efficiency condition here requires is that the extraction path and the consumption path have to be such that the rate of return to these assets is the same, okay, and it has to be equal to the social discount factor, okay. And I tried to convince you yesterday from an intuitive point of view. Often it's very difficult to here to get some economic intuition for the results because they're quite complicated sometimes. And but in general, the intuition is that is the one related to financial markets. Okay, so the no arbitrage condition. Okay, so that's what I try to convince you. Okay, but if yeah, I hope it was helpful. Okay, in understanding these conditions. Now, going back to these intertemporal trade-offs, there is one important result that I still have to discuss here. And this is known as the Euler equation, okay? And therefore, extraction path, remember what I just said, extraction path and consumption path have to be such that the rate of return to the assets is the same and equal to the social discount factor. Now, I'm going to show you an important implication of this, okay? In particular for the consumption path, okay? And this goes under the name of the Euler equation, okay? The Euler equation tells us how consumption changes over time, okay? So therefore we are going to here have a result about how consumption changes over time, and therefore we get information about the consumption path. This is in particular important, is particularly important for two reasons. Okay, so the first, which is we are interested in here, it's about sustainability, because remember, sustainability, in the case of sustainability, we would like to have that the consumption path, okay, this is what we are going to here to describe. So how a little bit about what is necessary in order to have sustainability. Okay. So this is the first reason why this is going to be important. The second reason is that the Euler equation can be brought to data. So by just looking at the consumption behavior and some additional data in order to estimate parameters of my problem, in particular the elasticity of substitution of consumption, and my discount factor, okay, in order to get some insights. Okay, so the how future generations value, how the present values future generations consumption. Okay, so therefore there is a huge literature on estimating Euler equations. Okay, so okay, therefore this is going to be very important for several reasons. Therefore, okay, now let's see how this is done. Let me perhaps do it. Since you have time, I want to. Okay, let me do it properly. Okay, so again, don't get. So I'm going to now derive this formally. Don't get too lost in the math. Try then to understand what's the result. Okay, and I'm going to focus again on the implication.
Professor.
Yes.
I have a question.
Yes, sure.
Could you repeat, please, what we can estimate using the Euler equation? Because I've lost.
Yes, the Euler equation can be used in order to estimate the elasticity of my utility function. Okay, let's set in this way. My sound a little bit. Let's say, okay, just stick with me in a minute, and I'm going to show you exactly what you can estimate. Okay. So.
Okay, thanks.
Because then I'm going to calculate everything, and I'm going to show you what you can estimate. Okay. But the important thing for us is that you can estimate the social discount factor. Okay, that's something that you can try to estimate. Okay. And that's going to be important for, so in addition to other things, okay, and but the social discount factor is important for climate change economics. That's why several scholars have tried over time, for different reasons, okay, to estimate these parameters, because they are important for many other reasons as well, for saving behavior and so on and so forth. And because clearly the discount factor of individuals affects saving behavior affects investment and so on. That's why the Euler equation can be brought to data, and then looking at estimating it, you can get insights in parameters that drive then saving, or in the case of climate change, what should drive climate change policies. Okay, because essentially, it affects how individuals value future consumption. Okay, let's put it this way. Okay, this is what you can try to estimate. Okay, so how individuals value future consumption. Okay, just by looking at the implication of the Euler equation, and bringing the Euler equation to the data. So I don't know if I've clarified it, but then I'm going to calculate, and I'm going to show you what you can do exactly. Okay. I hope I've clarified it somehow. Then I'm going to.
Definitely.
Okay, I'm going to calculate it now. And okay, so let's see how this can be done. Okay, so I'm going to use the following conditions here. I'm going to use the condition that the first static condition is I'm going to use the fact that the marginal utility of consumption has to be equal to omega, which is the marginal utility of output or capital. Okay, because remember here output capital is the same because of the assumption that output can be used for either for investment or for consumption or for other things as well. Okay, if you have a more complicated model. Okay, here it's just consumption or investment. Then the second condition I'm going to use is this dynamic efficiency condition that would be about the shadow value, shadow price of capital, and that is omega dot over omega plus qk equals rho. Okay, remember this is a dynamic efficiency condition which tells me that the rate of return to the asset capital, physical capital, has to be equal to the social discount factor. Okay, but the first term is the appreciation or depreciation of the value of capital, and the second is the instantaneous return to a capital investment. Now I have to combine these two, and by combining these two, I get the Euler equation. Okay, so how is this done? I take the first. Okay, I take the first and calculate the time derivative. Okay, if I calculate the time derivative, okay, you see I get that this is the second derivative with respect to consumption times the time derivative of consumption. Okay. And then what I'm going to do here is I divide everything by omega. Okay. So both the right-hand side and the left-hand side. But I know that knowing that omega is equal to the marginal utility of consumption. Okay. So therefore, what I get here is omega dot over omega is the second derivative, okay, of my utility function with respect to consumption over the first derivative, and this is and times omega times c dot, okay, the time derivative of consumption. Okay, now we are we're almost done. Okay, so no worries here. So now what I'm going to do is the following, because you see here, this is very similar. I mean, this is quite close to an elasticity. Okay, and therefore what I'm going to do is I'm going to multiply and divide everything by consumption on the right-hand side, so that I get U double C over UC times C, and this is C dot over C. Okay, so clearly everything, I mean, nothing changed compared with the previous equation. The only thing here is now this here is the elasticity of my marginal utility of consumption with respect to consumption. Okay, this is called the elasticity of the marginal utility of consumption with respect to consumption. Okay. Okay, and yeah, and this is what I'm going to call. Okay, here I'm going to call it eta. Okay, so eta. Since I know that remember the first derivative is positive, while the second derivative is negative. What I'm going to do here is I'm going to define eta as minus this second derivative over the first derivative times consumption. Okay, and this eta is the elasticity of the margin utility with respect to consumption. Okay. Now what I can do is, therefore this here is, let me repeat, this here is, this term here is minus eta. Okay. Therefore what I can do is the following. I can here write C dot over C as minus 1 over eta omega dot over omega. Okay, we're almost done. Okay, because now you see I know what omega dot over omega is, because omega dot over omega is something I've already calculated here. Okay, so omega dot over omega, so the growth rate of my shadow price is rho minus QK, so marginal product of capital. Now I can use this here okay in my and then I got the Euler equation. Okay, so we are, so if I make this substitution here, what I get is that C dot over C is the marginal product of capital minus rho over eta. Okay, and this is known as the Euler equation. Okay, this is the Euler equation. Is it more or less clear? I mean, mathematics are not very complicated, a little bit perhaps involved, okay, but it's just working with the first order conditions. Okay, now let me, before going to the interpretation and then the implications, the two implications, okay, I would like to talk about. Okay, so this Euler equation is something you get in all models where you have an so you see here, this is a general solution that where non-renewable resources for sure enter, but they enter in the marginal product of capital, as I'm going to argue in a minute. Okay, but this is true for all economic growth models. Okay, so therefore this is not specific. So what I would like here to you to notice is that this condition is not specific to the fact that we have here, we are dealing with non-renewable resources. Okay, this is a general result that holds for all problems where consumers face an intertemporal consumption problem. Okay, so for instance, in all economic growth models. Okay, in all economic growth models where consumers have to decide optimally how much to save. You have the Euler equation. Okay, both in you can have this is the Euler equation in continuous time. You can have the equivalent also in discrete time. Okay, if you have a discrete time one, but this is just a technicality. Okay, and here it is a consequence of these two first order conditions we have seen. Okay, and if you notice again. Okay, these two first order conditions, they are static and dynamic first order conditions, they are specific to the consumption choice and capital. Okay, so because this here, remember, is the output that is either consumed or invested, and this here is specific to my investment choice. Okay, so you see here, these two are specific to the part that's not related explicitly with non-renewable resources. Okay, is it clear? And it follows. Let me repeat this from first order conditions of my maximization problem. Okay, and you would have exactly the same result in all economic growth models. Okay, basically. Okay. It is true also in, here we have seen this in a decentralized way. You get the same result also in a decentralized economy. Okay, this is true therefore also, because it's a general result, you get exactly the same result I'm going now to discuss. Also, if you have a decentralized economy, so consumers choose optimally how much to consume, firms choose optimally how much to produce, and then you have equilibrium, and you get exactly the same. Okay. Is it clear? Clarified this? Okay. Because also here there was some confusion over past years. That's why I would like to spend more time on it. But clearly, we can use this, and I'm going to use this in our context as I try to argue, because the Euler equation, what does it tell us? It tells us what the consumption path is going to be. Okay, it tells us in particular what is the condition such that the consumption path is an increasing one or a decreasing one, or it remains constant. Okay, and why is this important? Okay, this is important in particular because in the production function, okay, in our case, you see, production not only depends on K, but it also depends on R. And therefore, the extraction of non-renewables, okay, affects my marginal product of capital, and thereby, here it depends the degree of substitutability between K and R. It affects whether we are going to have an increasing, a decreasing, or a constant. So what is optimal from a social point of view? To have an increasing, decreasing, or constant consumption path. Because this, let me stress this again, this here is the socially optimal consumption path. Okay, this here, which depends on the expression on the right-hand side, defines you the socially optimal consumption path. Okay, it tells you what is the socially optimal consumption path. And therefore, for us, it's important because we would like also to know whether sustainability is something that is socially optimal. Okay, so given that sustainability is different from the conditions of social optimality, we would like to know what are the situations where the two are indeed compatible. Okay, and when they are conflicting. Is it clear? Am I making sense? Is it clear? And that's what I'm going to do now. Okay, but first, let me give you some intuition of what the Euler equation is going to. It's telling us here. Okay, Okay, so what does the Euler equation tell us? The Euler equation. Okay, here, if you look at the right-hand side of the Euler equation. Okay, you see, you have two components. One is the marginal product of capital. Oops. the marginal product of capital, and the other is the social discount factor. Now, what are the two? The social discount factor is, I mean, it reflects impatience of a society. Impatience should reflect impatience of a society. So that is how we are going to value utility of future generations. And therefore, remember, we had utilities that were, so remember my setup, okay, here we had a social welfare function. It was like this, so it was minus e to the power of minus rho t u, which is my utility function ct, and here I'm integrating over t. Okay, here you see the larger is my rho. Okay, so the larger is my discount factor. Okay, the larger is the social discount factor. The lower I'm going to value future generations utility. So a lower way, I'm going to put a lower weight to future generations utility. And therefore I'm very impatient. I'm very impatient because I prefer consumption today rather than consumption in the future. Okay, it's more, I have higher weight on today's utility, which comes from consumption, rather than from future generations utility, which comes from future consumption. Okay, and therefore rho reflects impatience for future consumption. Okay, basically. Or put differently here, how future is valued by individuals, or in this case, more by society, okay, because this is really the discount factor of the society, okay, the social planners discount factor, okay. Then, what is the marginal product of capital? Well, that's quite clear. It's the payoff of delayed consumption, okay, because remember here, Q output can either be consumed or invested, and in this way it builds up capital tomorrow, and therefore, so the marginal product of capital is your return to delayed consumption, because if you decide to not consume 1 unit today, this 1 unit gets invested, and therefore tomorrow you have 1 unit of capital more, and this additional unit of capital gives you QK output, additional output tomorrow. And therefore, QK is the return to delayed consumption. Okay, so it's the return to delayed consumption. So let me repeat this. Okay, so if you decide to consume 1 unit less today, you're going to invest 1 unit. This 1 unit tomorrow becomes capital, and this additional unit of capital tomorrow gives you QK units of output. And therefore, QK, which is the marginal product of capital, is the return to delayed consumption. Okay, if you renounce 1 unit of consumption today, you get tomorrow QK, so the marginal product of capital, units more of output. Okay, so therefore it's a return. Okay, it's what I called, okay, yesterday and also previously, it's the instantaneous return to investment. Okay? And consumption, you remember there's a trade-off between consumption and investment. QK is your instantaneous return to an investment. Okay. Now, what is QK? QK, therefore, is, as I said, it's the payoff to delayed consumption. But if you look at it from an economist point of view, it is really how future is valued by the market. Because if instead here, if you think about, if you look a little bit more into the model, okay, so at an equilibrium, okay, if you think about firms now behaving in an optimal way, they are going to invest in capital up to the point where the return to this investment is equal to the rate of return on financial markets, or the opportunity cost of the investment. That is to say, this is something that you have perhaps seen in microeconomics. Okay, so if R is my interest rate, okay, is that here I'm going to make things very, very simple, because I'm assuming that it's just one interest rate. I'm not considering risk-adjusted returns and so on and so forth. So I forget about all these clearly important things, but I keep things very, very simple. Okay. Otherwise, it would be, the basics would be the same. It would be just much more complicated to explain. But here, if you look, let me repeat this. Okay, so what is, from an economic point of view, the rate of return of your investment? It is usually called R. Okay, because again, because of an arbitrage condition. Okay, so if I have to decide where to put my money, I'm going to compare the investment. I'm going to compare what I get in terms of instantaneous return from my firm and from the financial market. Okay, that's why QK should be equal to R. Okay, is it clear? That's how you, from a micro point of view, you hire capital up to the point where the marginal product of capital is equal to the interest rate, which is the opportunity cost of capital. Is it clear? You agree? It's not clear. Let me write it this way. Okay, that's something we have really seen this already in one of the first lectures. Okay, when I've discussed the optimal technique choice. Let me repeat this. Okay, so remember what firm profits are. Okay, so profits are Q, which depends on K and L, minus RK minus WL. Okay, I'm using L instead of my resource. Okay, because now remember here what the first order conditions here are. The first order condition is, so how much should I employ of capital should I employ here? Okay, so these are revenues. Okay, here I've normalized the price to 1. Okay, so the price here is 1. Price of output is 1 in this simple framework. Then what you do is you hire capital up to the point where its marginal product, which is your marginal benefit, equals to the rental price of capital. Okay, so R is the opportunity cost of capital. Okay, so these are revenues. So these are revenues minus costs. Okay, production costs. This is just a standard firm problem. Okay, instead of my non-renewable resources, I'm considering K and L. Okay, just to remind you some of the micro stuff you might have seen a couple of years ago. Okay, so here, therefore, how much capital should I install? Okay, what you do is you install up to the point where the marginal productivity is equal to the opportunity cost of hiring capital. Then what you do is you have also how much of labor should I employ. Marginal product of labor equals the wage rate. Now, if you divide the first by the second, you get the optimal technique choice we have seen a couple of lectures ago. Okay, so if you remember. So that would be QAL over QK equals W over R. So if you, perhaps I might have used a different notation. I've used the F function, the G function, and if you remember the models we have seen in international trade part. But this is what's called the marginal rate of technical substitution, if you remember. Perhaps I got you completely lost. I hope not. Is it clear? Long story short. Okay, I got you lost. Yes.
Sorry.
No, I mean, if someone is lost, I guess others either they're not lost or they're completely lost, or The only point I would like to make here is that QK here is how future is valued by the market, because it is equal to the market interest rate. Okay, so this is something that you get from the market. Okay, while rho is something that you get from consumers. So rho is how consumers perceive future, so individuals perceive consumers. QK is how the market, because it's at the end of the day, it's something that is the result of market decisions. How much of capital to employ, how much of labor to employ, how many resources to extract. And all this leads to the marginal product of capital, which is therefore a valuation of how the market perceives the return to savings. Okay, and therefore, what is saving? Saving is just foregoing consumption today in order to have something tomorrow. Therefore, how impatient the market is. Is it clear? I don't know how. Because just think about what is the interest rate? The market interest rate. The market interest rate is how the market, how much the market is going to pay you if you save. Okay, because if I save 1 unit today, so if I'm not going to spend 1 unit today, I put it in the financial market, and then I get, therefore, tomorrow I get the interest rate, okay, interest rate on it, and that will be my R here, okay, and therefore the market, this is how R is how the market values future consumption rather than present consumption, okay, because if you reduce your consumption today by 1 unit, you get tomorrow. You get this 1 unit plus the interest rate, and therefore you can consume this 1 unit plus the interest rate tomorrow if you want. Okay, and therefore it's how the market values the future. Okay. While rho is how individuals value future. Okay.
I think it is clear when we revise things. For example,
okay.
Today I was revising what you were saying before, the production technique, the optimal production technique that is determined by the relative price. So revising that concept, we can understand the marginal product of capital.
Yes, yeah, I guess yes. Yeah.
Can you share that the one on the right, your notes on virtual?
Yeah, sure. Always share them. Yeah. Yeah, always when I have notes, I always share them. Okay, yes, for sure. Yes, sure. If you're not, if once you revise things, think about things, should be clear. It really depends on your background. For those of you who have not a strong economics background or forgotten for one reason or another what you've done in micro, and clearly things might look a little bit. A little bit strange, okay, but I'm more or less repeating things that I've already said, okay, so that's why. Yeah, if there's no specific question, I don't know how else to explain things, okay, because this is more or less what you can do, I think. Okay, so therefore, yeah, no point in. I could explain. I mean, let me think. No point, I guess. No, I was just thinking if I could. No, it would just complicate things, I guess. Okay, now let's keep it here. Okay, if there are questions, okay, next time or otherwise, just send me an email, okay, if we do not meet, okay, and something is not clear. Okay, so let me, if you don't mind, let me erase things here, otherwise. Okay, so therefore, rho is how the how individuals value future consumption, while the marginal product of capital is how the market values future consumption. Why is it not okay? How the market values future consumption, and therefore here you see the following. So if the market, so the result is the following, okay? So if the market values future more, oops, sorry, this is wrong. If the market values future more than individuals do, okay, than the society does, okay, then what you have is that the right-hand side here you see of the Euler equation is positive, and therefore you have an increasing consumption path. Okay. So if the market values the future more than the society does, then you have an increasing consumption path. This is kind of intuitive because you see, at least I try to convince you that's intuitive. Okay, so what's going on here? You see, this means that I am more, as an individual, I am more patient than the market is, and therefore it pays off to have an increasing consumption path. Okay, so because you see, I am more patient than the market is. Okay, so therefore it pays off to delay consumption because the market pays more than I evaluate future. So the market pays future consumption more than I value future consumption, and therefore it pays for me off to delay consumption, okay? Because I'm more patient than the market is. So I get a higher return so someone is paying me more than I value things, and therefore I'm willing to accept the bargain. I'm going to delay consumption because what I get a kind of a premium. Let's put it this way, okay? If this perhaps is more convincing, the difference is the difference between how the market values future consumption I value is a kind of premium that the market gives me for delaying consumption. Therefore, if the premium is positive, it pays off to delay consumption because I get a premium. So I get paid more than it costs me to delay. And therefore, I'm going to delay consumption. And therefore, I have an increase in consumption. Is it clear? So let me repeat this. You can think about the difference between QK and rho as a premium, okay, paid by the market if it's positive, because QK is the marginal product of capital, is how the market pays me for delaying, how much the market pays me for delaying consumption. Rho is how much it costs me in utility terms to delay consumption. And therefore, if the market pays me more than it costs me to delay consumption, I get a premium, and therefore I delay consumption, and therefore I have increasing consumption path. So delaying consumption means that I consume today less than I'm going to consume more tomorrow, and so on and so forth. Is it clear? So let me repeat this, okay? So try to follow my reasoning. So the marginal productive capital is how much I get paid in order to, you can think about it in terms of how much I get paid in order to delay consumption. Okay. How much I get paid in order to delay consumption. I see you are having troubles, okay, in understanding why QK is the price I get paid in order to delay consumption. Okay, just very basic micro stuff. Okay, again. Okay, let me repeat what you have seen most likely in undergraduate studies. Okay, so let's assume the individual lives just 2 periods. Okay, so in this case you live just 1 and 2. Okay, 2 periods. So you have either to consume today or tomorrow, and therefore what you have is, and you have a certain income today that would be, let's say, Q, and let's call it not Q, because otherwise, let's call it M, okay, M1 and M2, which are the 2 incomes. Okay, so income in 1 and income in 2, M. Okay, and then I can delay consumption at the price. R, okay, R is the interest rate, okay, and therefore what you have from a micro point of view, okay, from microeconomics, we know that consumption therefore in first period plus savings in the first period is just equal to my income in the first period. So meaning that in the first period either you consume or you save, okay, and in the second period, since you don't live in the third one, you consume everything. That's why in the second you have that you have M2. You have to consume your income, and plus savings, which could be either positive or negative. Okay, R is my interest rate, and therefore. Here you see I have a positive saving. Saving can be either positive, so saving is M1 minus C1, and this can be positive. Clearly, if I consume less than what I earn in the first period, but saving could also be negative if I consume more. If I consume more than what I earn in the first period. Okay. Now you should see now why R is the price of delaying consumption. Okay, because you see what I can do is now I can simplify things here. I can substitute the first in the second or the second in the first. If I do this, let's do the following. I can write C1 plus C2 over 1 plus R equals M1 plus M2 over 1 plus R. Okay, this is the budget constraint. Therefore, what is the opportunity cost of consuming of consumption today? Okay, what is the opportunity cost of consuming today? Okay, if I consume 1 unit more today, so if I change consumption by 1 unit, okay, you see, in particular if this is positive, okay, so if I consume 1 unit more today, what I have is that I have consumption tomorrow, given that my income is clearly unchanged, okay, because this is not affected by my income. This is minus 1 plus R. Okay, because I consume 1 unit more today, I have so suppose this is 1 unit of debt, okay, I have to repay the 1 unit plus the price of debt, which is R. Okay, therefore you see here, R is the opportunity cost of consuming today. Okay, is it clear? Because if I have delta C2 over delta C1, this is just minus 1 plus R. Okay, therefore, it is the opportunity cost of consuming today. So if I consume 1 unit more today, you can also think about it in these terms. If I consume 1 unit more today, I forego 1 plus R units of additional consumption tomorrow. Okay, that's why R is the opportunity cost of consuming today. Is it clear? This should help in understanding why R is the price of consuming today from the market point of view. Okay, from the market point of view, because this is the market pays me. Okay, R, the market pays me R if I forego 1 unit of consumption today. Okay, is it clear? But remember now, if this is as well kind of fast, but I hope it clarified. If it was too fast, because it's basic stuff. For those of you who remember, this is clear. It's not basic stuff for those of you who have no memory of this clearly. Okay. Okay, this is just from the budget constraint. You can see you see this is the consumer's choice, but I've just here depicted the budget constraint. Okay, that's why, because it's budget constraint is how the market, through the market you substitute consumption today with consumption tomorrow, and the prices are. Okay, so substituting consumption today with consumption tomorrow is the prices are. Okay, so this let me read for those of you who have no memory of this. Okay, if I reduce 1 unit of consumption today, tomorrow I get back this 1 unit plus the interest rate R. Okay, that the market pays me R to renounce this 1 unit of consumption. Okay, therefore it's what the market pays me. Okay, now let me go. If there are no questions, let me go back to what I said above. Okay, if there are no questions. Now, because remember, yeah, what I tried to convince you previously, this is my QK. Okay. So now if QK is, so my marginal product of capital is larger than rho. Okay, rho is how I value future consumption, okay, as an individual. How I, from a welfare point of view, value future consumption. R, or the marginal product of capital, is how the market values future consumption. Okay, that's why I have to compare these two. So if the market values future consumption more than I do, this means that the market pays me a greater return than I would require to delay consumption. Okay, so the market pays me more. Okay, then I would require to delay consumption. Okay, because rho is how I value future consumption. Okay, so the market values future consumption more than I do, and that's why for me it's convenient to delay consumption. Okay, because I get a higher interest rate than I would require to delay consumption. And that's why I'm going to delay consumption. That's why you have C dot over C increasing. Okay, because the market pays me more than I would require to delay consumption. On the other side, if the market pays me less than what I would require to delay consumption, then I'm not going to require to delay consumption. I'm going to decrease consumption over time. Okay, because I value the present more. Okay, and therefore the market doesn't pay me enough to delay consumption. That's why I'm not going to delay consumption. Okay, the market doesn't pay me enough. Then I would require to delay consumption. That's why I'm not going to delay consumption. I'm going to consume more today than tomorrow, and so on and so forth. So delaying consumption means that today I'm consuming less than tomorrow. Okay, so I'm delaying, postponing consumption. Okay, hope we are on board. Okay, and consumption remains constant if the market pays me exactly what I require. And therefore it's constant. Consumption is constant. Okay. Is it clear? Any questions? Okay, if there are no questions, I would like to take a break now, because then after the break, I would like to talk about the two issues that, okay, perhaps what I could do now is, because I'm going to talk just a little bit about it. The question was also from home. So the first, remember, there are two topics. One, I would not like, I'm not going to spend too much time on it. And that is the Euler equation is here, can be used to estimate parameters of that measure how individuals value future consumption. Okay. In particular, rho. Okay. And why this? You see, in particular, rho. Okay. Why this? Because you see, QK, the marginal product of capital, is something that I can calculate from the data. Okay, because QK is the rate of, it's the return, the instantaneous return of capital investment. Okay, the market interest rate. QK is the market interest rate. QK is the market interest rate. And it's readily available. Data are readily available. Consumption path. The consumption path is something that I can obtain again by looking at cohorts of individuals. Okay, or also aggregate data. You can see what is the saving behavior of a society. Okay. And therefore, you see, I'm not going into technical details because, again, this is a econometrics problem. Okay, but there is a huge literature on starting from this Euler equation to estimate these Euler equations. And in particular, what the authors try to do is to try to estimate how individuals value future consumption. So the rho parameter here. Okay, and it's quite intuitive why this can be, why it's possible to identify this, because R, the interest rate, is readily available by looking at the data. Also, the consumption path is something that's readily available because you have household consumption, you have aggregate consumption data. And that's why, in this way, because the Euler equation is something that has to be true if individuals behave rationally. Okay, if individuals behave rationally, then they should behave according to this Euler equation, because what they do is they compare what I just said, how the market pays them to delay consumption, and how the individuals delay, consider future consumption. Okay, and that's why it makes kind of sense given the discussion I had. So if individuals behave rationally, what they do is they compare what they get paid in order to delay consumption with what they perceive, okay, they should be paid, okay, in order to delay consumption. That's why individuals that behave rationally behave according to the Euler equation. And that's why, assuming that the individuals are rational, you should infer from the Euler equation, you should be able to infer from the Euler equation how individuals value future consumption. And that's very important when we go back to our climate change economics, because rho is very important for climate change policies. Okay, and that's why how this literature kind of affects. I mean, the literature I just mentioned affects the literature on climate change economics. Is it clear? I mean, what I tried to had something clear. There's a huge literature, okay, on this. I'm not going into the details, okay, and not going to try neither. Okay, it's clearly beyond the scope of what I would like to do here, but it's just to let you know, okay, that this is therefore also given the reasoning we had, okay, this is makes kind of sense, okay, and it has done, okay, has been done. Okay, I would like to stop here because after the break, I'm going to talk about how this now, the Euler equation, is useful in order to study the issue of sustainability, okay, because we are concerned about sustainability. Okay? And in the case of non-renewable resources, okay, and therefore, as I mentioned in the introduction a couple of lectures ago, okay, clearly the matter is the degree of substitutability. Okay, we're going to talk a little bit about this after the break, if you want. Okay. Okay, so have a nice lunch and talk to you if you want after the break. Okay. All right. Thanks. Sì. Ah, adesso chiudo tutto, sai con le slide? No.
No, sono cosa del libro.
Ah, ok.
Posso rispondere? Sabe
Ah, ok, sì, certo. Okay, so let's start. Okay, so let's start. So what I would like to do now is talk about sustainability. Okay, given the result we have seen, what can we infer in terms of sustainability? And as we're going to see, this is in particular going to depend on the degree of substitutability, okay, and therefore this goes back to the discussion we had at the very beginning of these lectures, okay. So sustainability and substitutability therefore are strictly related, okay. And here, for the moment being, I'm just going to use the Euler equation and some results in order to get some insight, okay, some very basic insights, yeah. And then, so next week, okay, I'm going to solve explicitly an example, okay, a very simple example. I'm going to calculate explicitly extraction rate and then see how this is going to affect the issue of sustainability, okay? But here for the moment being, let's try to obtain some general results, okay? So here, since I don't have notes here on this yet, I'm going to write some. I'm going to write some notes on the right-hand side. Okay, so I'm going to argue what can we infer now in terms of sustainability by looking at the results we've seen right now. Okay, now remember the discussion we had before the break. Okay, before the break we have seen that. The Euler equation basically tells me that it is socially optimal to have an increasing consumption path if the return to savings from the market point of view is larger than my impatience. Okay, so my rho parameter here. Okay, in this case, it is socially optimal to have an increasing consumption path, or so at least it has not to be. I mean, Q, the marginal product of capital has to be not lower than rho. Okay, this is the condition we would like to have. Okay, so therefore, to summarize this, sustainability is socially optimal okay, if my marginal product of capital is at least as large as my rho parameter, so the social discount factor. Okay, this is the result. Now, the problem here is that the marginal product of capital depends not only on capital, but also depends on the resource that is harvested here. Okay, the resource that is extracted and used in the production process. And we know the following. We know that because of the fact that my resource is finite, and my resource is finite, I'm going to extract over time a lower and lower amount. So RT is decreasing over time. And therefore you see, since the marginal product of capital is increasing in R, you have that Q, the marginal product of capital decreases. Okay, so let me repeat this. So you're going to extract, so you have to, in order to be able to produce, you need the non-renewable resource. But since the non-renewable resource is finite, you're going to extract a lower amount. But since the marginal product of capital is increasing in the use of this non-renewable resource, you have that the marginal product of capital declines. Okay? And therefore here you see the issue, this is what we have already seen, okay? Nothing new. The only thing here that's new is that we need this to be, for sustainability, we need this to be larger than rho, okay? So now we have a threshold, it's kind of a threshold level. So sustainability is optimal only if it is sufficiently large. That's what we are saying here, okay? And therefore, the crucial role, there's a crucial role between K and R, okay? The degree of substitutability. Okay, so how K and R can be substituted, this now you see plays a crucial role. Okay, because if the marginal product of capital is goes below rho, then sustainability is no longer socially optimal. Okay, is it clear?
Can you repeat the last sentence?
Yes, let me draw a picture, okay? That's even better, okay? So let me draw a picture, okay? So then it's even clear, okay? I have this picture later on, but let me perhaps already draw the picture now, okay? So it's clear. Okay, so the marginal product of capital, so here I'm going to depict the marginal product of capital. Now, what we know is that, let me draw this as a function of K. Okay, you know that the marginal product of capital is decreasing. Let me see if this picture here helps. Okay, the marginal product of capital is decreasing. Let me, for simplicity's sake, okay, draw this just a straight line. Okay, can you read? Okay, this is my marginal product of capital. And then, what I also can draw here, I can draw my sigma. Okay, this is my, sorry, my sigma, my rho. Okay, sorry, sigma is the elasticity. Okay, here. Now, what happens is the following, okay? You see, if R goes down, okay, then this straight line, okay, the marginal product of capital declines. Okay, because this here is drawn for, let's say, R0. This here is drawn for, I hope you can see, okay, R1, where R1 is lower than R0, okay, because R is declining over time, okay. Now you see here, now you see the issue here. If now you see, if I keep capital constant, okay, if I keep capital constant, then here, and suppose at the beginning it was just at the threshold, then here we just have sustainability, so that sustainability is socially optimal. But here, now my capital is such that, and my capital and my resource is such that I have that sustainability is no longer socially optimal. Okay, you see this, okay? And therefore, what you need to do is, you need a sufficient degree of substitutability, okay, between K and, oops, sorry, this is not rho. This is R1. Okay, sufficient degree of substitutability such that you are able to have sustainability social optimum. Okay, therefore you see here, going back to what I said before, if my R declines, my marginal product of capital declines. And therefore you need a sufficient degree of substitutability here between K and R such that sustainability is socially optimal. Okay? Otherwise, the two are incompatible. Okay? The two are incompatible. Okay, is it clear? Now let me, I'll go back to this picture the next lecture, okay? But what I'm going to do now is I'm given the constant elasticity of substitution function, I'm going to show you what is necessary here. Okay, I'm going to show you with a very simple, with an example, okay, simple example, what I just said here, what's the implication, okay, in terms of the production function. Remember so therefore this goes back to my discussion about production function we had a couple of lectures ago, okay, if I remember. So remember what a constant elasticity of substitution production function it looks like. That is a k to the power of minus theta plus b r to the power of minus theta, and this was to the power of minus epsilon over theta. Oops, theta is nice. Okay. Now, what is the marginal product of capital? I already calculated this once. Okay, so very, yeah, kind of going fast over this. I've already done this. So I have to take the first derivative with respect to k, because now I would like to see what the Euler equation looks like if the production function is a constant elasticity of substitution one, okay? And that's why this is useful. A plus k to the power of minus theta, b times r to the power of minus theta. And here minus epsilon theta minus 1, and then times the internal part, that would be minus theta a, oops, minus theta, sorry, yeah, k, k, minus theta minus 1, okay? This is the marginal product of capital. I can kind of simplify things here, just to rewrite things in a simpler way. And therefore this is minus times minus becomes plus, so this is epsilon a k to the power of minus theta plus b r to the power of minus theta minus epsilon over theta minus 1, and then times k minus theta minus 1. Okay, this is my marginal product of capital. Okay, now remember, I have to compare the marginal product of capital with my rho. Okay, this is what requires this is what is required if we are concerned about sustainability. Okay, so meaning that the consumption path is a non-declining one. Okay. Now here you see sustainability. We have seen a result, okay, in a previous lecture that stated that sustainability is feasible if theta is negative. Okay. Theta is negative. Yes, because in this case, remember, my elasticity of substitution was 1 over 1 plus theta. Okay, in this case, elasticity of substitution is larger than 1. Okay, if you remember. Okay, the result we have seen. Now here, why is this important? Okay, so why is, oops, I wanted this to be red. Okay, why is this important? You see here, in this case, you see, if theta is negative, then what can happen is R remember, which is my extraction path, can go down to 0, can become smaller and smaller over time. Okay, and if R becomes smaller and smaller over time, we still have a finite marginal product of capital. Okay, if you take the limit here of R that goes to 0, okay, that what you have here, what remains here is the following. So let's just do this, okay, in order to get here the result, -1 times k minus theta minus 1. Oops, -1 you can see. But you see, this is still a positive amount. Okay, it doesn't go to, it doesn't go to 0. Okay, because this is what we were concerned here. Okay, remember here you see, the problem is that my problem was that this goes to 0, and therefore that this condition was no longer satisfied. But here, this is not necessarily the case because this does not go to 0. Okay, and therefore the degree of substitutability in this case between k and r is sufficiently large that you can have that this is larger under certain conditions, it's larger than rho. And therefore, you see what I tried to, I don't know how convincing this example here is, but what I tried to argue is that if the general result, if sigma is larger than 1, meaning that the elasticity of substitution between k and r is sufficiently large, then sustainability not only is feasible, but it's also socially desirable. Okay, that's something that you would like to have also. Okay, while as I'm going to show you the next lecture, this is not necessarily the case if sigma, for instance, is equal to 1, or even if sigma is lower than 1. Okay, in this case, you might end up with situations where, in particular, sigma equals 1, sustainability is feasible but not socially desirable. Okay, so here in this case, sigma larger than 1, sustainability is feasible and socially desirable, socially optimal. Well, I'm going to show you next lecture that in the case of sigma equals 1, even though sustainability is feasible, it is not necessarily socially desirable. Okay, that's something I'm going to show you next time. Okay, with an example. But is it clear? The problem here you see, this goes down. So in principle, you would have, by keeping k constant, this should go to 0, and therefore sooner or later, even if you start with a larger one, sooner or later this condition is no longer satisfied, and therefore sustainability, remember, which requires QK being larger than rho, is no longer satisfied if QK goes to 0. Okay, and therefore this condition is violated, and therefore sustainability is no longer socially optimal. Okay. But if the degree of substitutability is sufficiently large, this does not happen. Okay, as I've shown here in this example. Okay, is it clear? Try to argue, okay, in this example, because basically here in the example I've depicted here, the input is not essential, okay, because the picture I've drawn here, or the calculus I've done here, for theta lower than 1, the input R is not essential, okay, and therefore you see the importance of substitutability and essentialness. Okay, for substitutability and for sustainability. Okay. Okay, now let's. I'll go back to this next week. Okay, if something here is troubling you, okay, no worries. Next week I'll explain everything. Hope with another example, more carefully. Okay, starting from 0, kind of 0. Okay, by calculating everything. Okay, and therefore. Things will become clear, okay, if something was not right now. Okay, so what I would like to do in the remaining part of this lecture, I will just discuss what is the empirical counterpart of what we have seen here. And in particular, one that from the model we have seen here, 2 things can be brought to the data. One is the Euler equation. As I said, Euler equation can be used to estimate the social or the individual's discount factor, and therefore how individuals value future consumption compared to how the market values future consumption. But the other, even more important implication is that the model gives you a prediction about the price behavior. Okay. Now there is the following prediction, okay, here. The following prediction about prices, that is, the price should grow exponentially. Because remember, P is the shadow price of my resource, the shadow price of my non-renewable resource. And given the intertemporal trade-off individuals face, the optimal extraction path should be such that the price of the resource, the shadow price, and here the counterpart, the empirical counterpart would be actual prices. They should grow at an exponential rate and equal to the social discount factor. Now here, the only thing you should a little bit worry about is that prices here, according to the model, they're not in monetary terms, but they're in utilities, okay? But still, it's a growth rate of prices, and we know that since the growth rate is independent of the unit of measure, okay? That's why we should not worry too much about this issue, okay? Because it's a growth rate, and therefore it's independent of the unit of measure. So what should one see in the data is that the prices of certain non-renewable inputs grow at an exponential rate, okay? And some authors have looked into this, okay? And I'm going just to show you some data on it, even though I'm not going to test the theory. I'm just going to show you some data and then see whether the prediction is supported by the data or not, okay? Here, these are therefore data, for instance, for real price of copper. Real price means that we do not take into account inflation here, okay? It's real price. It's not so inflation adjusted price, if you want, okay? So it's not that here the price reflects also the general increase in prices, okay? Here It's an inflation-adjusted price. Of copper here, it's for 1870 to 2004. Clearly, you would like to have a very long time period, okay? Because this is a prediction of a very long time period. And yeah, this is the first picture. As you can see, there are huge fluctuations, but fluctuations are. I mean, if you forget about fluctuations, the mean is not the average here is not significantly different from zero. Okay, there's huge fluctuations around zero, and what you should expect is not fluctuations around zero, but fluctuations around a positive number. Okay, because the social discount factor is positive. Okay, is it clear? So fluctuations should be can for sure be fluctuations, but they should not be around zero, but it should be around a positive number. Okay, so here not supporting the data. Now this is lead price of lead for 1870 to 2004. Same story more or less. You see huge fluctuations, but again around zero. And what you should, or what we expect from the data is fluctuations around the positive number. Again, not supporting the theory. So for the moment being, the model is not working the way we would like to. Same story, zinc for 2004, same time period. Again, huge fluctuations around zero.
What happened in that year?
This is around the World War, I guess, so could be related to that. Okay. It's around 1915, so I guess it's related to what happened to the market around the World War I. Aluminium, yeah, you see the same fluctuations also around here, 1915, so that's why I guess it's for inputs. Again, huge fluctuations around zero again, and something that you would, at least you'd hope not to see in the data. Same story here. And nickel also. And silver. Okay, so if you look at data for several non-renewable, this is natural gas. Kind of interesting. Again, yeah, rate of change. Okay, now we have huge spike, huge increase again because of war, and yeah, but perhaps here is interesting to see there is a trend. Okay, here one might see here positive. So for a certain part positive, but then again downfall. I'm going to explain why this might happen in a minute. Okay, because I'm going to now to argue that the model we have seen is too simple, and we can somehow fix the model to fit the data better. Okay, because we are clearly missing some parts, and I'm going to talk about.
Are you referring to the econometrical model?
No.
To
our model we've seen. Yes. No, there is no econometric model here because these are just data. Yeah, that's just data. If you look at raw data, okay, and you would like the model to somehow predict these. Okay, and here what you would like to have, say it's 2%, you would like to have fluctuations around 2 rather than 0. Okay, and you don't see this. Okay, this is what we are missing here. Okay, that's why our model is not performing well. So fluctuations are, you see that there is an increase, but then following the increase there is a sharp decline. Okay, and I'm going to argue why this might be the case. Okay, so what we are missing in the model we have seen. Coal also here in this case you see increases yeah, you see, you might be interested in this sharp increase. This is related to the energy crisis, I guess. In the 70s, there was the energy, the oil price increase, and this could therefore have led to an increase in the price of coal. Okay. Petroleum here, same story. Okay, huge fluctuations. Yes. So conclusions. What are the conclusions? Okay, and so what are we missing in the model? Okay. So what you can see. What are the observations? So observations are high volatility in real rate of change, the rate of change of real prices, and the volatility appears to be centered at 0. So that is to say, the author here, I've taken these results from presidential address by the president of the Canadian, at least in 2007. The Canadian Economic Association, okay, who gave a presidential address on the hoteling rule and the empirical counterpart. And even though the author did not test it, so there is no statistical test whether the average is significantly or not significantly different from 0, but the data are quite compelling. Okay, if you look at it, okay, it should be a shift upwards. Okay, rather than it's really centered around 0. Okay, so therefore the author concludes that the rate of change of price is not statistically, not significantly different from 0, and according to Hotelling's rule, it should be significantly different from 0. So therefore, this begs the question, okay, so where is this scarcity rent? Okay, we have mentioned now several times. So where is it? Okay, so I've now tried to argue several times that there is a scarcity rent. It makes kind of sense, okay, so the resource gets scarcer and scarcer as we are going to use it, okay, because it's available only in a finite amount, okay, and therefore the price should increase, and this should lead to a scarcity rent. So is there something wrong with our model? Okay, so the question therefore is there something wrong with the Hotelling rule? Okay, or are there some elements we are missing? So is the model we have built so far too simple, okay, to be able to make a real-world prediction? Okay, so are there elements that are able to offset the increase in the resource rent? Okay, so are there elements we are missing that offset? Let's think about these together. Okay, we have a couple of minutes. Okay, so what are we missing from your point of view? What are we missing clearly the model is too simple, so we are missing a couple of things. So what is the main thing we are kind of missing in the story? If you think about natural non-renewable resources, okay, so you have to think about it. Okay, so we know that there are certain resources available in a finite amount that are known, and therefore we are going to use these up over time, and therefore, according to economic theory, price should increase. But you've seen this is not true. The price more or less, I mean, there is no over a very long time period, no strong price change, okay, over a very long time period. So what are we missing in this story? Any ideas? Technology improvement in, so you mean that we are becoming more efficient and using less or less? Or
it's less costly to extract 1 unit.
Exactly, yeah, exactly. That's something we are missing, okay? So that was not in the model. So we are missing extraction costs and the fact that extraction costs over time got cheaper. And clearly this is one element that offsets, okay?
But at the same time, if we extract more and more of our resource, we also have to put more of our tools, technological stuff to extract 1 unit of the same resource. For example, if we think about oil, and we have to dig deeper and deeper
exactly,
to
yes.
extract it.
Yes. Yeah, that's why usually if we are going to model extraction costs, So extraction costs, you would like to model them in the following way. So if you have extraction costs, they usually depend on the stock available and the amount you extract. Okay, and then there could be technology improvement in these. Okay, now as the stock declines, costs increase because you have to dig deeper. Okay, like you said. So therefore, if the stock declines, costs increase. Okay, that's why here you have a negative dependence here. And the more you extract, clearly the more, so the faster you harvest the resource, the higher costs are. Okay, and therefore, yeah, there could be these two offsetting effects. But if technology improvements are sufficiently strong, okay, they could be dominant. Even also because there is a second component that is missing in the model, and that could offset your argument as well. So what are we also missing? We're missing something else. So one thing is extraction costs, and extraction costs are declining over time, and therefore the resource gets cheaper because it gets cheaper to extract resources. Okay, this is one thing. Then the other element we are missing here is what? Think about again oil. So what happens always, or natural gas over time? What happens? Also think about in relation to extraction costs. So trying to drive you in the direction. I don't know if I get you there.
Is it something related to the resource itself?
Yes, to the resource itself. So one thing is the physical availability of the resource. The other thing is whether it's economically profitable, okay, to use. We know that there are many resources that are physically there, but they're just not profitable to use, okay, because it's perhaps too costly to extract. So that's why there are two things that might therefore help. So first, as extraction costs go down, it becomes cheaper to extract these resources. And on the other side, as the price increases, it becomes more profitable to extract these resources. That is to say that the resource per se is not really fixed over time. So the economically viable, okay, amount is not fixed, but it changes over time depending on extraction costs and the price of the resource itself. Okay, and therefore you can think about it in this term. So as the price increases of the resource, it becomes profitable to extract more resources. Okay, that before were not profitable. Okay, is it clear? This is because of a price increase. So you know that the resource is there, but it's just that you're not going to use the resource because it's too costly compared to what you can profit from it. But as the price increases, they might become profitable. Okay, and therefore the resource increases. The amount of the resource increases. Okay.
Why does it increase?
Because
it's almost physically impossible to reach the oil, for example. Even if the price is high, what's the...
No, because there are some that are physical, that are possible to reach. Okay, it's just that it's too costly. Okay, you have to dig deeper and deeper and deeper, and as long as the price is low, it doesn't pay off to dig that deep. Okay, but then if the price is sufficiently high, it becomes profitable to do so, or if extraction costs go down. Okay, and therefore, before you had a smaller amount of the resource, but then as the price increases, you have an increase in supply. Okay, it's like an increase in supply. And if you have an increase in supply, we know that the price drops. Okay, there's another thing we are missing. Related to this issue is also the fact that as technology improves, we are able to find more and more of the resource. We might be able to find more and more resources, okay, because now we are We have better technology that is better at finding resources, okay? Cheaper to find resources, okay?
Then, in this view, we will never get rid of fossil fuels. No?
Well, we know that for sure, since we have a finite planet, okay, we have a finite planet, for sure the resource is finite, okay? The problem is clearly if the price continues to increase, more and more of the resource will be exploited. Sooner or later, it will come to a stop because we will use all of the resource. Okay, but there is the point from not to get rid of fossil fuels. Okay, what we should do is we should drive producers from using fossil fuel to renewable energy sources. Okay, and there the problem is a problem of prices. Okay, so that and productivity. Okay, well, which is just the opposite. Cost or productivity is just the opposite. Okay, that is to say that still based on fossil fuel technologies, okay, the productivity is larger than productivity of renewable energy sources. Okay, that's why what the policymakers should do is reduce this wedge, okay, in productivity, such that producers now use renewable energy sources rather than fossil fuel. Okay, because in this way, what you do is you will have. This is another thing, perhaps, that can lead to a decline in prices, because in this case you have a decline in price because of not an increase in supply, but a decline in demand. Okay, so if you switch from fossil fuel to renewable energy sources, okay, so you reduce the demand of fossil fuels. Okay, because you substitute fossil fuel with renewable energy, and this drives down demand and therefore the price. Okay, but then by driving, you see down the price. Why? The price simply is driven down because of demand and supply. But then this again makes fossil fuel more convenient. That's why you see it's kind of tricky for the policymaker to, because the problem is that fossil fuel is there. Okay, it is there, and therefore, since it's there, and as long as extraction costs are very low, okay, you can also give it away for free. Okay, let's say okay, so the price can go very, very low. Is it clear? That's why it's very difficult, okay, to switch from fossil fuel to renewable energy sources, because the resource is there, and since it's there, if extraction costs are very low, I can give it away also for free. Okay, so very low price, and this makes dirty technologies very convenient. Okay, this is clearly a huge problem. Okay.
But prices get higher, but as prices get higher, isn't it also because the resource gets scarcer?
Yes. On the one side, the price gets higher because of scarcity. Okay, this is true. But then you see, as the price gets higher, scarcity can also become less severe, because as prices get higher, more of the same natural resource becomes profitable. Okay, and therefore you have an increase in supply. Okay, so suppose, okay, just to draw again a picture. Okay, if you would like to reason with a picture. Okay, so if this is my supply, okay, fixed supply, okay, this is my supply, and then I have a demand. Okay, now here you have two forces. Okay, so since the resource gets scarcer and scarcer over time, okay, you have a decline in supply. Okay, so therefore the supply curve shifts towards the left. Okay, this is my price, and therefore the price increases. Okay, this is the scarcity trend. Okay, but now what can happen is that as the price increases, at a certain point in time, supply increases. And why is this the case? Because now new resources become available or profitable, okay? For instance, before it was too costly to exploit some resources we knew were there, but simply it was not profitable to exploit these resources. And that's why it can happen that the supply curve shifts to the right, okay? And that's why the price now starts declining.
Okay, but it's a negative loop because of
Yes. Yes,
resources are there, but at least they are just finished. So
yeah, they're the planet as a whole is a finite. Okay, so sooner or later they are going. I mean, for sure there is going to be an end. Okay, to it. The problem is, when is this? Sooner or later. Okay, because also over time, if the price continues to increase, it and the technologies, okay, to find new resources improve. Okay, we might find new resources. Okay. Clearly, also this also depends on many policies implemented. Okay, so here, for instance, we know also very close to us in our sea here, close to us. Okay, there are many in the Mediterranean Sea here. There are many gas resources, natural gas resources, but just the government has decided to not exploit these resources. Okay, so if you have seen the data, okay, now given the energy crisis we are experiencing, okay, you see these data now in the daily news. Okay, Italian production of natural gas has declined over the last decades. Okay, because of environmental concerns. Okay, so because of concerns related to polluting the environment. Okay, so that's why this is therefore clearly nowadays we pay the price for this decision. Okay, because we are in need of energy sources, and we pay a high price for these energy sources, and it's a policy decision, okay, made years ago. Okay, and clearly it's something we can't undo now. Okay, because it takes time clearly to extract these resources.
So it is possible to say that the increase in resources is just in the short term?
Yes, yes, it's in the short term, but then again, I don't know how short this term is. Yeah, okay, because we don't know how. I mean, we really don't know. At least I don't know and I think it's impossible to know what exactly the amount of resources are, because technologies get better and better, okay, in finding new resources. Okay, clearly it depends on I'm thinking here about oil or natural gas or whatever. We know for sure there are many other issues. Okay, about scarcity of certain metals in particular. Okay, materials that are needed in high-tech industries. Okay, so we know for sure they are in very limited supply. Okay, and this might be a problem for future growth. Okay, and there is a big debate about. Okay, and also because many of these materials are located in countries like China and less developed countries, and that's why this also is a policy problem. Okay, so how, and also kind of connected. I'm kind of digressing here. Okay, but it's I think an interesting discussion. Okay, so you see also the policy issues now. How should we deal with the Ukrainian war? Okay, because clearly we know that. I mean, we have to think not only about today, but also what's going on in the upcoming years. Okay, and there will be for sure, let's say, kind of war for these kind of materials that are in very short supply and that can influence growth paths in the future. Okay, and therefore it's really a political issue rather than an economic, because they are located in specific parts of the world. They are infinite, at least that's what we know. But then you see, as time evolves, also think about it also as technology evolves. You can really get rid of some inputs, but then others might be necessary. Okay, this is really technical improvement. Okay, you see, as the price of certain inputs becomes exponentially high, there are huge rewards to come up with alternative solutions to get rid of these inputs. Okay, that's why you can never make a prediction, okay, about what's going on in the future, because of and this is the nice thing about the competitive economy, okay, because here it is the inventor then gets the rewards. Okay, so there are huge rewards to come up with technological solutions that eliminate bottlenecks. Okay, so like having to deal with countries that I depend on in supplying certain inputs that are very scarce. Okay, and therefore the price I have to pay is very, very large. Therefore, the reward to come up with an alternative technology that's able to produce the same good, but with other inputs that are not that scarce, okay, it's huge, and therefore the reward clearly gets to the innovator. And therefore, you see here there's a race for innovating, okay? And this is something that's quite nice in competitive economies, okay? Because you see the rewards goes to the innovator. In a planned economy, there is no such activity, okay? Because then you have to foresee everything, and that's kind of complicated, okay? If you don't have price signals as an information device, okay? But here it's just prices that signal. You see, this input now is exponentially large. And we know that in the future we won't be able to produce, I don't know, high-tech stuff without this input. So, $billions to those who've come up with an alternative technology that uses other inputs that are not that scarce. Okay, therefore it's very difficult to make predictions. That's why also you have these fluctuations in the price. Okay. Because, I mean, as soon as there is a price increase, you come up with efficiency improvements, you find alternative solutions, alternative energy sources, and so on and so forth. Okay, all these things we are missing in the model. Is it clear? Kind of questions so far? Is it convincing? Any other thoughts on this? No thoughts. Okay, great. So I would like to stop here. Okay, I would like to stop here. And if you want, we can meet again on Tuesday. Okay, and on Tuesday we're going to see one of the two last topics. I don't know if I'll talk very briefly about how the model changed with renewable. Perhaps I'll just very briefly go over the model, okay, just to give you an insight on what happens. And then, yeah, perhaps I can do this. And then last lecture will be on a very simple model of climate change, okay, where you have pollution. Okay, so thanks again for attending, and talk to you if you want next week, and have a nice week, okay, a nice evening. Bye-bye, thanks.